This recording is looking at non-reversing entries, and I'm in your resource book on page 85. So what happens with all our accruals and prepaids is on the first day of the financial year, we reverse those entries. The reason why we reverse those entries is because the matching principle, and we're matching the revenue and expenses to the year that they are being incurred. However, there are some entries that we don't reverse. In chapter 14, we covered depreciation, so I'm not going to cover it again. But depreciation happens on balance day. It's part of the balance day adjustments. When we do depreciation, we certainly do not reverse the depreciation on the next year, for the next financial year. Depreciation is recorded on the last day of the financial year on balance day, and then does not change. We also have another non-reversing entry, and this is for our inventory. We're not talking about a periodic inventory system. We are talking about a perpetual inventory system. Remember, your perpetual inventory system is a system whereby stock counts are not done on a regular basis because we've got the use of barcoding. So when customers purchase items, they're barcoded out to the store. When stock comes in, they're barcoded in. Now, sometimes in this whole process, there are breakages, okay? And breakages often are not scanned and barcoded the inventory system and recorded as wastage. There's theft, very common in supermarkets, etc., where obviously the goods certainly are not then being barcoded out of the system. We also get instances of goods perhaps going rotten, those sorts of things, and then they're not scanned in and out the system either. So on the very last day of the financial year, organizations that are using a perpetual inventory system, or might not be on the last day of the financial year, a few days leading up to that, they will actually do a physical stock count. Now, this physical stock count, some organizations you might have seen, the likes of Red Dot, they actually close for a whole day to do stock take. Other organizations such as Woolworths and Coles do the stock take at night when the store is closed. So I'm looking at the example on page 85, and it's the example with nuts and bolts. So nuts and bolts use a perpetual inventory system. The business provides the following information relating to inventory. The physical count on the 30th of June 2019 reveals the inventory value of $89,000. The perpetual records show an inventory value of $91,520. So in this instance, the computer records are showing that the stock has a greater value than that of the stock that's been counted. So obviously we've had instances of theft, etc. in this organization. So what you are required to do is prepare a general journal entry to adjust the records to account for the variance. And you need to also do the extract of the income statement, assuming the balance of the cost of goods sold prior to stock take is $300,000. First step you've got to do is say, okay, I'm going to do my workings down here. My computer tells me that my stock is 91,520, but my physical stock count is only 89,000. So can you see I've got a $2,520 difference? So we've got to take $2,520 out of the inventory account because we no longer have this inventory, and that has been a cost to us. Now remember, the cost of inventory is put into an account called cost of goods sold. And remember, this is an expense account. It's an expense account that is going to get closed off to the trading account. So we need to have our double entry principles and have the two accounts balanced. So they also tell us in the example that the cost of goods sold prior to this happening was $300,000. We now have this additional cost that is being added of $2,520. So now our cost sold is $302,520. So your extract on your statement of financial performance or your income statement will obviously be sales and whatever your sales amount is, less your cost of goods sold, which is now no longer 300,000, but it's now 302,520. The reason being is we did an actual physical stock count, and our physical stock count was less than our actual inventory count. Now, you have to bear in mind that sometimes you might get an instance whereby your actual physical stock count is more. Okay, and this does happen. So in which case, say this was a situation where the stock count was more, it's going to be slightly different. So I'm just going to put my 302,000 back in there. Okay, sometimes we might have a situation where you do the inventory stock count and the inventory was more than the 91,520. Say the inventory recorded was more than perpetual system. Then, and say it's by $3,000 more, then our inventory account has to increase by the amount of inventory that we have on hand. And you also now need to reduce the cost of goods sold. So even though we have our cost of goods sold as an expense, this time it's going to be an expense that is adjusted. You're probably thinking, well, an expense always goes on the debit side, and now you're saying that this is going on the credit side. What I'm going to do is I'm just going to bring up a T account and say I put this T account over here, and we call this T account cost of goods sold. And for the example that we've been looking at, they told us that on the last day of the financial year, the balance of our cost of goods sold was $300,000. Okay. Obviously, in this situation here, our inventory was less, hence our cost of goods sold became more. Okay, and we work that out here in this question here. However, here we've got a situation where our inventory on hand was $300 more than what our computer system said. So in this instance, we've got to go to cost of goods sold, and we've actually got to take out $3,000. Okay, so you know that we then need to balance the account. So what would be closed off to the profit or to the trading account, I should say, is going to be obviously your 300,000 minus your 3,000, and in which case our cost of goods sold balance that would be closed off to the trading account is 297,000. So you're all probably saying, well, why is cost of goods sold an expense account being closed off to the trading account? Because all the other examples we've looked at, whenever we close an expense off, we're closing it off to the profit and loss account. And whenever we're closing a revenue account off, we're closing it to the profit and loss account. But now we've got an instance where we're not closing it off to the profit and loss. We're closing it off to an account called the trading account. Now, this trading account is where everything goes that is part of the formula for gross profit. So you know that the formula for gross profit is sales less cost of goods sold. So when we close sales off to the trading, sales will go off to the trading account on the credit side. Okay. All our expenses associated with the cost of goods sold will get closed off to the trading account on the debit side. Okay. You'll then find that the difference between the columns, your sales in a viable business will always be greater than your cost of goods sold. So you would then balance off the account, and your balancing figure would be here. And you would then post this and close your gross profit off to the profit and loss account. So then I'm just going to reproduce directly under that. I'm going to reproduce the profit and loss account. And the profit and loss account has all the accounts in it that are associated with the calculation of net profit. Now, net profit equals gross profit plus other revenue less other expenses. So we now are going to have a situation where we're closing off the gross profit to the profit and loss account. So our first entry will be gross profit. We then are going to close off all our expenses are going to get closed to the gross profit, the net profit account. Any other revenue will get closed off to the net profit account. Then it's really important that you understand that if we've made a net profit, our balancing figure will appear here. Just like we had our balancing figure here, our balancing figure is now going to appear here. And this balancing figure is going to get closed off to the capital, because it's in the capital account that we are going to record the net profit or the net loss. So obviously it's going to be a profit if it is recorded here as the balancing figure, and if this column here is higher than this column here, then the balancing figure will be here and it will be a net loss. That's not part of this actual unit, but I can't explain to you why the cost of goods sold gets closed off to the trading unless I provide you with the two new accounts that we actually learn in the next chapter, which are both the trading and the profit and loss. So far, you've just looked at the trading account. So in summary, we looked at non-reversing entries. Depreciation is a non-reversing entry. And then we also have the counting of our inventory in a perpetual inventory system. Okay, and counting of our inventory in a perpetual inventory system means that we actually have to take things out of inventory and add them to cost of goods sold, or put them into inventory and take them out of cost of goods sold. The reason why I have also done this example here is because one of the exercises that you need to do in your book has it where the inventory increases and not decreases. You are now able to do the self-test exercise 5 on page number 86.